Okay, it is 9 o'clock. Today we're going to be doing a session on symbology. Here in the Foundry, the Foundry is designed to be a meeting place and a community where traders can get together and discuss different ideas and share and collaborate one with another to build a better community, to allow for people to come in and ask questions and such, and it's free of cost. It doesn't cost anything to be here. Unlike many platforms, they always want to make money, and we're here to help traders. This is a community of thoughts and ideas forged in the crucible of objectivity. We try to be objective in everything that we do, and then it's purified in the Foundry for the benefit of all. Purification comes from the discussion that happens here, from the interaction. So that's what we want to do today. First of all, what do we know? A smart man knows what he doesn't know. W.F. Bartley. W.F. Bartley was my granddad. Very, very smart man. Very wise man with barely made an 8th grade education. But he was very wise, and sometimes our education school level does not really speak for what we actually know. Sometimes that school of hard knocks can be a good teaching tool. So what do we know? Symbols are used to determine the contract that is displayed and used for order execution. Order execution, whenever you trade in futures market, and symbology is what we're talking about here today. In that futures market, in order to trade, you have to have a specific contract. Well, how do you know which contract you want? Because there's many different contracts for each asset. For example, crude oil. There's contracts that go out at least 2 years every month. So that's 24 contracts ahead that I know of that they have for crude oil. So which contract do you want to trade? Well, really, honestly, it depends on what you're trading, what your style of trading is. You know, if you're looking at long terms, then you want to maybe trade a contract that's 3 or 4, maybe 5, 6 months out. If you're doing options, so there's different things that you can do. But you need to have the right contract, the right symbol, so that you get the results that you want. The price of each asset is determined by the contract. So each contract has its own price scale. You can look at contracts for 2 different expirations, and you'll see that they have different prices on those contracts. They scale differently because they expire. They have different expirations. You have time built into contracts, and time and volatility. And so that determines and affects the price of the contract. One other thing that we know is that rollover doesn't occur the same number of days from the end of contract every time. And one of the things that we found out just in this last expiration of the TY, which is the 10-year notes, it rolled over 7 days ahead of time. So rollover doesn't occur the exact same time every day, every contract. So what is rollover? Rollover occurs when the volume in the front month contract is exceeded by the volume in the next month contract. So what does that mean? So we'll just throw some numbers out here. If you have, say you have 10,000 contracts traded in a particular asset contract A, 10,000 contracts today, and same asset contract B, you have 9,000 contracts, and that's the next month contract, then with contract A, it still exceeds the volume of the contract B. However, when B contract has a greater volume in a particular day, say B contract has 11,000 contracts and A contract only had 9,000 contracts, then rollover has occurred. So whenever you have that day of trading, and what we've run into is that sometimes you may have a fluctuation where they're very, very close, and one is just barely over the other. And so what we've done is gone to 2 consecutive days of higher volume. And that gives us a good indication that contract is actually rolled over. So 2 consecutive days, and we'll show you that here as we get into the next slides. Now, one of the things that I've done, and this is just a screenshot. So when we talk about symbol selection, we need to determine what we're trading. So such as the S&P 500 is ES. And we see that represented down here in this chart. This is a screenshot of an Excel sheet that I have, that I use. We see then here the S&P 500 is ES, and the expiration months are H, M, U, and Z. So it trades quarterly. It's traded on the CME exchange. Minimum price or tick value is 0.25. Okay, and there's 4 points or 4 ticks to a point. Okay, on the ES, it's $12.50 a tick. So that's the value of each tick. So I have this chart set up, and it just gives me a quick reference. And then we have here the unadjusted symbol for the chart is ES, or at ES equals 107XN. However, and we'll get into this a little bit further as we actually get into showing you some of these symbols. This says that it's going to roll over 7 days before contract expiration, the 107XN. And like I say, we'll talk more about the symbology as we get a little bit further into this. But I've set this sheet up, and these are things that I've looked at over many years and looking at different things, and I've categorized them into stocks, indices, the treasuries, currencies, and I also have softs, and I have commodities as well on the sheet. But I said this just gives you a quick example of some of the different things that we look at. Okay. So from here, let's go ahead and look at TradeStation. Okay, I have a chart, and you can see here, this is, come on. Well, fine, we'll do it this way. Maybe. Okay. We'll get it here. This is TY12, TYM22 equals 114XN. And this is the standard. This is what most people use for the TY. And this would be the one here, and we'll actually get into, just go in here and we'll edit the symbol. We can see it a little bit better here. At means it's a continuous contract, the at sign. TY is the root, which is the 10-year note. ILM is the current contract, which is ILM is the June contract, and then 22 is a year. Those are the elements that you need. The TYM22 is the actual physical contract that you're trading at this point. So when you get into the @ sign right here, then that tells us that it's a continuous contract. And it's going to roll to the next month. The one here is the next month. And when is it going to roll? It's going to roll 14 days before contract expiration. Okay. Now then, we can go in here to properties. And in properties, we can see when the expiration is 6/21/22. We go over here. Can y'all see my calendar here that just popped up?
Okay. Yes.
Okay, so let me go back and get the calendar here. So this is June 21st, 6/21. Okay, and this rolls on Tuesdays, the third full week of the expiration month. Okay, so this is going to roll here on Tuesday. So and this contract at 14 days before, and this is not calendar days, this is business days. So it would be 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. So it should roll on Wednesday, the 1st of June. Now, that's historically, that's when they roll. But what we found is that it doesn't always roll on those days. In this particular case, the 10-year note, this last rollover, which happened the first beginning of this month, rolled 7 days early. It rolled at 21 days instead of 14 days. And what you get into is you get into charts that start looking really, really funny with gaps and spotty and such, because there's no volume. The volume is gone. So let's go back over here. Let's go back to settings. Okay, so an easy way to do this, to look at some of these things, is we can go into lookup. If we go into lookup, go into custom charts, here we have TY. Okay, and you can see currently what we have, TYM22 equals 114XN. So let's go in and examine this a little bit. When we do this lookup on this custom futures contract, we see that March, June, September, and December are highlighted and checked. That's the standard rollovers when these contracts roll over. And what do we want to base the data series on? The nearest contract. Okay, we have choices here. We can go to the second nearest, third nearest. Okay, typically when you're trading futures, you want the front month contract, which is the nearest contract. Okay, and then we have here, we have time as the expiration, and it's 14 days prior to expiration date. Okay, we can do prior to delivery date, first notice, whatever. Okay, do we have all these choices? But we typically want for trading, we want prior to expiration. Okay, and that's all set by 0 months. And this is an unadjusted chart. Here we have absolute difference, ratio, and unadjusted. Typically you trade unadjusted. When you get into trading these others, the chart will actually go in and fill in on the gaps between the contracts, and it will give you effectively fake news, fake information, things that they have generated based on the averages between the two contracts. And, I don't want to trade fake news. I want to trade something that's real. So we'll always use the unadjusted. Okay, when we check this symbol here, okay, we can use this symbol for trading, then it completes this information. And so say if I wanted to go in here and put 21 in here, and you see my symbol up here, and I go, okay, it just changed it to 21 here. So this is going to expire 21 days ahead of time. Now, do I want to do that because it did it last time? No. What I really want to do, because rollover is based on volume, we want to go to contract, and we want to go to activity. We want to go to, and we have open interest here, which is one way of doing it, but we really want is volume. Okay, when we go to volume, and here we have consecutive trading days of higher volume. Okay, now one doesn't necessarily give you a good rollover date. We've gone through and played with this and experimented with it. One doesn't actually do the best. What does is a 2. If we have 2 consecutive days of trading of higher volume, then we have a good rollover date. When we do this, we end up with a symbol of at TYM 22, which is the contract, equals 12 bond. Now then, if we go to the second nearest contract, the 1 in front of the 2 and the 12 bond, that will become a 2. We now have 2, 2. Okay, so we see how this is all tied together. We want to go the nearest. So this is where we end up with, we go, okay. And this is on a 15-minute chart. I'm looking at 2 months of data. And we'll just do okay here. And we'll see if it will load. And I've got the tools running in this, and I probably needed to turn something off so it would load faster, but I did not. So after it loads here, I will go in and turn that off. Is there any questions to this point? Please feel free to use your microphones. Ask questions. Okay, there we're back up and going, and you can see the tools that S&D Software has built here. So let me go in and turn off a couple things in the tools. I've been running some back tests with this particular chart, which that's another thing that we'll be talking about at a later point in time. So we're going to turn off band test here. And we're going to turn off the logging. Okay. So here again, it'll take a minute for that to get caught up. But we can see, and I'm going to change this to a higher time frame again. For what we're doing here will actually be a better way of looking at it. Okay. Let's see if it will give me the opportunity to do this. Okay. And what we see here in the tools, we see supply bands and demand bands. Supply on the top, which is the dot dash lines, and the demand bands are solid. So we see these things, and they're that's a different session, but that's how the tools are set up to function. So let me go in here and go to data, edit symbol. Of course, it brings it up on the other monitor. And this is on a 15-minute. So let's go to a 60-minute chart. And I don't want 9 months of data. I'm going to do 2 months of data. Actually, I'm going to go back to last date. I'm going to, instead of 4/1, I'm going to pull a date back up here in March. March 9th, and I'm only going to pull 1 month of data. So I have it set on exchange time so that any of my testing that I do will always be on the exchange, and regardless of where I'm at. Okay, so I'm going to look at 60 minutes here. Okay. Now then, we see here on 14 days rollover. This is when rollover should have occurred on 3/2. Okay. Rollover actually occurred on 3/25 back here. And you can see these, everything here looks reasonable and decent. Okay. If we go in and look at TYH contract, can't do that. If I do that, it's going to bring me to a current date, and I don't want to do that. So let's go in here to go to data, edit symbol, and back to TYH. 1 month back, 3/9. That still works. Okay. Actually, it expired on 3/22. 3/21, but 3/22 will work. So we go to let's just do 2 months. Actually, let's go to weeks, and we'll do 5 weeks. We don't need a huge amount of data. Okay, so you see what everything's looking like here. And as you get up into here, which it should have rolled over on 3/2. Okay. And we're going to look at this right here. 3/2 should have been the rollover date. Okay. When you get up into here, this is a 60-minute chart. You start seeing some really small candles. Okay, you see one right there on a 60-minute, and that's not typical for the 60-minute chart. Okay, and when you get on up in here, you see really small candles and gaps and all these different things here. So what we're going to do is we're going to go in here and go to data, edit symbol, and we're going to go back to 3/2, which is the rollover date should have occurred. And I'm going to go back, let's go back 9 days. And we're going to go to a 3-minute chart. And it's like 9 days. Every time you change this up here, something changes down here and you have to go in and look at it. Okay, last date's 3/2 and we're going 9 days back. Okay. A lot of people would not trade a 3-minute chart. And okay, so here we go. Okay, we see this funny looking stuff up in here. That's on 3/2. That's when rollover should have occurred. Okay, but we also see it over here and in here, and you see these gaps and such in here. Okay, we see it in here. Here's 227. Okay, we see, and this was a weekend gap right here, by the way, guys. So weekends can be pretty gappy. We see gaps over in here. Okay, this is 2100, 2130. This is Globex hours. Okay, and you don't normally see these things in the regular market. Okay, here you'll see here we have small candles. We don't have the gaps that we saw. Okay, so what's the date on this? This is 2/23/11/12. Okay, so that's midday. Let's see, 2/24. 2/24 looks fairly decent. Okay. We can get into 2/25 right here. This is when things start getting funky. We're seeing gaps here. We see a gap here. We see a gap here. Maybe I already looked at that one. Okay. So I'm going to do a screenshot here of 3/25. Actually, just going into 3/26. This is when it gets really funky. Or not 3/20, 2/26, excuse me, February. 2/25, 2/27, which is the weekend. Okay, so let's go in here. I'm going to screenshot. Let's just go here to here. Okay, now then, move that over the side. We're going to go back and change this to the continuous based on volume. Edit symbol. 3 minutes, and then we want here again. Let's just go through this lookup again. Go custom futures. We want TY. Okay. Find root. Okay, so we don't need that. We got it there. TY. We want the nearest contract, and we want 1 consecutive days. Let's do 2 consecutive days, and we're going to do volume. Okay, and we want to trade this. Use a symbol for trading, so we're going to use the exact month. So we want unadjusted. which gives us the 12 VON, volume unadjusted. Okay. And 3-2, 9 days back. That looks good. Okay. Let this build. And I have not tried this ahead of time, but my suspicions are that we're going to have different bands shown for this contract than what we had from the previous. That's why I did a screenshot.
Based on my experience, you will see very different bands.
Yeah. Okay. So let's go back to, let's just get this and pull back over here. Okay, this is what we just did a screenshot of. Okay. And so let's go back to 227. This big gap here is a good marker here. Okay, there's a big gap. Okay. So now then we have this band here, this band here. And we still have some funky looking stuff in here. So let's go and compare that to what we had here. Okay, we have the same bands there. Okay, so these bands actually came out the same. Well, not exactly. We have this band right here that is not on this chart here. Can you see my mouse?
Yes, barely. You need to make your thing bigger.
Yeah, it doesn't get any bigger on the screenshots.
Oh,
so we have an additional band here. So we see then that you can get different bands. We had a band here. Was that band over here? Come on. Yes, it's still there. Okay. So we see then that we can have different bands that come up. So let's just do a screenshot of this section through here. This is where we started seeing differences in bands. Here. So this is the TYM22. Okay, so let's go back to data, edit symbol. This would be 114XN. Excuse me. 3-2 and 9 days back. Okay. In doing back testing using the volume symbol rather than the fixed number of days, we have seen as much as a 14% increase in successful bands. So that's a significant amount. Okay, so we want to go back to the gap. What did we actually have over here? Okay, so we're looking at about 7 o'clock on whatever day this is. Figure it out here. Okay. So we're looking at price in here. $7 o'clock. Okay. 7 o'clock right in here is where we started. Okay. So this is our contract. Okay. And you can see, let's see here. Okay, so we have a band right in here between, it's going to be about 126. Well, that's interesting. Okay, so we have this band at 126. Well, it doesn't show the price on it. It's going to be about 126 something in here. Okay, so let's go back to TradeStation. 126. So we have this band down here, and then from that we have a band here, and then we have this funny looking stuff up in here. Let's go back to our chart.
So Doug,
Yes.
one of the things you notice as you look at the bands created during the rollover time frame, this may be something we want to look at, but it looks like they do not perform well.
Yes.
Yeah,
it looks like they're just going through and busting.
Yeah, because I mean, you're looking at, you've got what, one, maybe two bands on that chart.
Yes. Okay. So
two bands, maybe two bands.
So right here.
That didn't stop out.
Yeah.
Before meeting 1-to-1.
Yes. So we're looking at this area right here is this area right here. And we can see that there's a band there that, and this is on the bond contract. Okay. So it came in here, your leg out was right here. It came back and retested the next candle and then bounced and pulled away. Okay, this band doesn't even exist over here. So let's just pull this down a little bit. Actually, yeah, it doesn't exist.
The band doesn't exist because you're actually getting different candles.
You're getting different candles, exactly.
That's the key.
And so that's the particular case where this band here would have made a significant move. Okay. As you can see, it easily made 1-to-1. That's probably a 3-to-1. Copy. Well, I can't do that. It's not going to let me do it. But you can easily see there's a 3-to-1 in there. Okay. That does not exist on this other chart. So this is at 127.12. 127.12, it would be right in here, and it's not there because you can see the difference in the candles. So that's the difference, and that's why it's important to get the right symbology. And like I said, we've run into multiple times. We had one of the indices, I believe it was it ES or MES, that normally rolls 7 days ahead of time. It didn't actually roll until 3 days before the contract expiration. And volume was still higher on the front month than it was the next month. And it just didn't roll. So if you had tried to trade the next month contract, you'd been trading a lower volume contract. Questions or comments? Has this been helpful to anybody?
Yeah, and Doug, one comment I wanted to make, if you're tracking your different futures contracts in a radar screen, you can actually just put the specific contract, the TYM 22, and then compare it to the TYH 22 and see, just track the volume. That's another way that you can make sure that you're trading the correct contract.
Such as what we have over here.
Exactly. Yeah, that's
okay.
That can be.
I actually have volume on this. It's just way over to the other side over here because I do that. Okay. So what's our next month's contract TYM? Help me out here, Lisa.
Let's see, we're let's see, HM U. Had to think a minute.
U22 equals just TYMU.
Mm-hmm. Yeah, 22. Yeah.
So okay, I want TYM.
TYU
22. There we go.
TY.
Yeah. TY.
Nothing like having backseat drivers, is it?
There we go. Okay. There you can see your volume difference. 34 contracts today. So would you want to trade something that has 34 contracts? Yeah, probably not. That's that's almost as bad as trading lumber. Typically, lumber has 4 or 5 contracts a day. So,
question for you, Doug.
Yes.
You say you wouldn't want to trade it because of low volume. What if rollover is scheduled in 3 days, let's say, and the volume will be higher when you want to get out because you're not a day trader? You want to hold this, you like this price on this contract and you want to hold it for a while because you are anticipating movement in your favor.
Well, that's why I said at the beginning.
Buying it?
Well, that's what I said at the beginning. And there are people that trade that do spreads between contract spreads because they know that the price typically is higher. If we okay, right now we're at 120, 127. Okay, if we go here and do TYU 22, we're 121. 21. Okay, so we see a difference there. We just load another matrix here. Find it. And we'll just do that's TYU. Okay, TYM 22. Okay. Here we're at 121.27. Here we're at 121.21. There are people that trade these just because of the spreads in the difference. You'll also notice here, see the gap between current price and the bid ask gap here. You don't have that here. You also have here, you have 1,396 contracts being offered at this price point. Here you have one. How hard is it going to be to get filled over here? Are you going to get filled where you want to get filled? Okay. So, you know, there's reasons to trade a higher volume market. Now, if you're doing options, that's a different story. Or if you're doing spreads, that's a different story. I think people will take the spread between these two and sell one and buy the other one. And as price moves further apart or closer together, depending on which way they took their spread, then they make more money on one than they do the other. They lose money on one. They know they're going to lose money on one while they're making money on the other one. And the difference between that is their profit. So that's what people do sometimes with spreads. Now, when you get into spreads, TradeStation does not have a good system for doing spreads, but there are other platforms that do that. When you have a spread, when you put on a spread, your margin, instead of being, you know, this is about $2,000 a contract, their margins drop to $150, $200. So that's an advantage with other platforms. So, but, you know, that's something to consider as well. So instead of tying up $4,000 to do a spread here in TradeStation, you literally could tie up, you know, $200 in some of the other platforms. So, Steve, does that answer your question?
I missed most of it. I'll go back and look at the tape.
Okay. Well, we'll just go back because I need to go back to that anyway. We'll go back to this here. We'll go back up here. The price of the asset determines what contract is contract dependent, and we just saw that. We saw two different prices for the same asset, but two different contracts. There's multiple different contracts available on each market. They have different rollover dates and different expirations. And what you need to think about is, you know, what's your purpose? What are you trading? And you need to select the symbol for whatever you are trading, not specifically for the front month. You may not want to trade the front month. As I said, with a spread, you may want front month and second month, or you may want front month and third month. You know, and I know, you know, you're looking at longer term movement. So let's go back to TradeStation. Let's go to the Z contract. This is TYU. Let's go to TYZ. Oh, wow. There's nothing in TYZ. Nothing's been traded today. It's there. It's out there. You can trade it. The problem is, where are you going to get in? You know, this is 811. Here we're at 122, 121. Okay. So where are you going to get into this? And after you're in it, how are you going to get out of it? Okay. So let's look at TYH 23. Let's see if there's been anything traded in it today. Okay, that contract not even open yet. So in this particular case, the only contracts, you've got 3 contracts that are open currently. You got the ILM, the U, and the Z. I'll go back to here. So how important is knowing what you want to trade? It's pretty important. Okay. So let's look at ES ILM22, which is our current, and then ESU22. Okay, so here we're at $45.33. Here we're at $45.30. Okay. You can see the difference in the volume and the difference in the movement. You see the difference in the gap between buy and ask. So let's go to ESZ. See if it's even open. It is. Here we're at 45.60. So, and there's no volume. There's no contracts being offered. There's been a few traded today. There's one traded here and one traded here. There's been 2 contracts. Okay, so if you get into that, how are you going to get out of it until it actually gets there? So where's this going to be? You know, these are probably people that are hedging a long-term trade, is what I suspect. Okay. So like I say, and price makes a difference. Let's look at something that has a, let's see, crude oil. What's the current contract of crude oil? CL. Is it J? Nope, it's not J. Do I know what the contract is supposed to be?
I show it's K.
Okay. CLK22. There we go. So the next contract is what going to be ILM. Okay. So here we're at 98.38 and here we're at 99.92. So we see a significant difference between the two. So that's kind of where we're at. And the we can see the importance because of when you're trading in the swing trading, day trading, either one. You want to get into the correct contract because it does make a difference in the price, the entry point. We got about 5 minutes here. Any last questions? Okay. So if you want more information, go to smdsoftware.com. It's free to register and you have free access to the Foundry. So there's no charges to come into the Foundry to be a part of these sessions. Please feel free to come in and join the sessions at any point in time. The Foundry is open virtually 24 hours a day. It's reset daily around 10 p.m. And this is a Zoom room, and we can only keep it open for about 26 hours, something like that. And they reset. So we reset around 10 p.m. every evening. And there's generally somebody here. Any further questions? If not, we'll end this session, and I appreciate you all being here and participating in the questions that were asked.
Thanks, Doug.
Thank you.